Hello and welcome to another episode of Miriel Talks, where we dive into the intriguing world of finance, investments, and the global economy. I'm your host, Yannick Parch, and today we're going to be discussing Black Swan events, so what they are, whether they're becoming more frequent, and what, if anything, investors should do about it. Joining me, as always, is the Miriel Fund Portfolio Manager, Mark Lazidi. Hello, Mark. How are you?
Hi, good afternoon. How are you?
Very good, thanks. So before we get started, a quick reminder that this discussion is intended for information purposes only and obviously should not be construed to be investment, financial, or any other form of professional advice. So with that out of the way, Mark, Black Swan events, what are they and why do they matter?
Yes, Black Swan event. What an interesting subject. It's even referred to unpredictable and rare events with potentially catastrophic market consequence. There are this type of event which can analysts consider extremely unlikely event. We're talking about here an event with a probability the 1 to 100,000 chance of occurring. So here, definitely the probability is quite extremely low. Such events should occur once every 100 years. For today's discussions, you need to be prepared. Why? Because you will be a time traveler. We will go from now to 100 years ago and from now to 10 years ago. Now, let's pass through a sequence of quick succession of rare events which took place not long time ago. And in this case, we will start with, which is not a surprise, 2020 COVID-19 pandemic, following by the war in Ukraine in 2022, and recently the bankruptcy of few regional banks. At the date we are filming now, it's not far away that the first collapse of the First Republic Bank took place, which was the third US regional bank, pushing the US authority to move to stabilize and reassure the market to avoid maybe a major recession and obviously a banking crisis. Now, let's travel in the past. What happened 100 years ago? As you can see here, World War I, the Spanish flu, the Great Depression. But what's the difference compared to today? It's probably the events were spread differently through the time. It took years, even decades. Now, as we say, 2020 with COVID-19, Ukraine 2022, and bankruptcy 2023. So as you can see, there is like clearly a different velocity of the events, of these extreme events. It's interesting to say also we notice a certain trinity on this event.
And I guess the major effect is that, unlike in the past when you might have one of these events and a decade passes, markets will have time to adjust and recalibrate. But now when they're coming, one after the other, there isn't much time in between them. So we are having the cumulative effect of all of these events all at once.
Definitely. I mean, we are living in a different world. I mean, we are living in a far more globalized, more interconnected world, I would say. Today, a news can travel across the world in a few seconds. To put the things in perspective, today in the world of finance, for example, if you we can stop like few minutes on the hedge funds industry. They are using high frequency trading. And the success of a failure of a trade can depend simply how close you are to the server of the exchange. So clearly, we are in the war of seconds. How the information is spread to the world or to the server.
And so I guess, how should we be looking at it? Is this just a new normal? Do we kind of just have to adapt to the fast pace of things today?
Definitely, I think, Yannick, we should say yes. I think we are living in a more and more interconnected world, and definitely, which can create like a contradiction here because more Black Swan events, at the end of the day, it will become not anymore a Black Swan events. a possibility that it will be priced in by the market. Nevertheless, I think currently the market volatility is extremely low. It's counterintuitive because it could change in a second with unpredictable event. In this case, it's like, are we standing, and this is the feeling we have at the moment, are we standing in a calm water just before the storm? Because it's so difficult and challenging to predict if the storm is coming in 1, 2, 3 months. And I will say, I want to put the light on something very interesting, which is as a professional investor, I will say the landscape changed drastically since the pandemic. The rise of the retail investors and the democratization of the participation in the financial market has been changing our current landscape. Why? Retail investors are emotionally more attached to the stocks compared to institutional investors. And this is clearly a fact. Now, the past years, online trading platforms making possible for everyone to invest in the stock market, especially in US, we discussed in the past. So definitely, it's like you can feel at the moment there is a decoupling between the market consensus or expert view and how the retail investor are feeling about stocks. And they become very attached on certain stocks. And it's obvious that some are overpriced just because the retail investor, they really love it. I'm using the term which is quite strong, love it, but they really love it. So definitely, since the pandemic took place, as we discussed in the past, massive amount of cash have been in the market. And since there, this big bull market took place between March 2020 up to the end of 2021. It sprang a lot of money there.
Can you give us some examples? I mean, what type of stocks are we talking about when we talk about ones that have been affected in this way?
I mean, definitely, I will show you some chart in this case. But the thing is, let's speak about the hype. The hype came after, and I will say the post-pandemic world, the stay-at-home stocks, where we can say Netflix, Shopify, Zoom, clearly. So here, let's start with Netflix. Everyone knows Netflix has been a leader back when it was started. But nowadays, you can ask yourself, look at this. I mean, definitely we can start here in February 2020 and look at this hype up to, I will say, the end of 2021. And suddenly, the things getting sour. We can also see the next one, which is Shopify. Look at this. We get even more hype in this case. If you remember back at that time, everyone wanted to order online, etc., scared to go out, etc. So it was really playing a center stage here in this post-pandemic world. Let me finish now with the third one, which is Zoom. I mean, as you remember, everyone wants to stay at home, having a video call with your colleague or your friend, etc. So Zoom was really in the hype, and we see how's the things going now. So the question is like, clearly all these stocks have a massive run on this kind of thematic stay at home. How is the continuity, especially after 2021? And we see not really fantastic. Again, for us, it's a question of low barrier to entry. And also, they have quite mono product. If I'm taking the case of Netflix, now you can get access to Paramount, you can get access to Disney Plus. Same story for Shopify and Zoom. Obviously, if we use on a daily basis Microsoft Teams, why we should use Zoom. That's why it's so important to discuss the valuations and really what's the growth plan of all these companies, because after the acquisition of a lot of user, what's the plan, what's the next step? And for this, I wanted to go with you with some resilient tech stocks, not only in the hype but going beyond that. Here, obviously, our favorite one and the best performing one, which is Microsoft. Microsoft, definitely, it's a fantastic company. For me, it's more like a conglomerate because active in AI, as we know. The recent hype is clearly on that side. But it's beyond that, it's also a cloud infrastructures, have access also with the Xbox on the gaming side. And I will say finish, I will say on the operating system. When it started the journey as a company just dedicate on the operating system. Let's go to the next one, ASML, of course, one of our favorite, and a lot of investors they love it. I mean, they are just at the beginning of the supply chain here on the chip. Definitely, we cannot live without ASML, knowing its positioning at the beginning of the supply chain. And let me finish with the star of this one, NVIDIA. I mean, fantastic trajectory. Definitely a very volatile one compared to Microsoft or ASML. But wow, what trajectory here. And I know you like to discuss about this, Yannick, about CPU versus GPU. Of course, NVIDIA is in these directions on the server side. So clearly here, I will say, if we put this in perspective of the stay at home, who's got been like a hype, and now it's over, especially after 2022. I will say the other one, which are Microsoft, ASML, and NVIDIA, they are here to stay, and it's more like a structural trend.
Yeah, in fact, I was going to say, because it's quite clear from the charts as well how they all declined during 2022, but then the companies like Microsoft, ASML, Nvidia, companies which are making products that you can't really replicate, they've started to bounce back, whereas the others, I guess, while you might have accumulated lots of users, I guess maybe people are conscious of the fact that someone else can come along tomorrow with a slightly different and better product and take away those users. To what extent do you think that's a factor in their poor performance since the?
I mean, for sure. I think one example in this case we didn't discuss here is Tesla. I mean, obviously a pioneer on electrical vehicles, but nowadays everyone is producing electrical vehicles. So again, where is the barrier of entry? I will say in this new world, it's quite fast. And again, I really like the term of velocity. The barrier of entry is becoming from high to low in a space of maybe months, that it could take in the past maybe 4, 5, 6, 10 years to get this, because it was industrial bet, etc., etc. So now in this cyberspace, I will say, or virtual space or digital space, it takes not so long for company to enter in a certain business. And that's why we appreciate more like company like Microsoft, who are acting as a conglomerate on the different sectors, who are not yet interconnected, but they can be interconnected. And definitely Microsoft with AI adding to his research engine, the artificial intelligence is going in these directions to interconnect everything. I mean, check about Office 365. Office 365 nowadays, it's like what? You get Word, Excel, but you have also Team, etc., etc. And soon you will have artificial intelligence. So they don't know yet if they're interconnected, but they think it will become interconnected. So clearly we are going in these directions. And if you are just like a company, just on a mono product like Netflix in this case, it's very difficult. That's why, for example, Disney is maybe better because they have the amusement park. So they are diversified in the case. When Netflix, they are just on a stream. So that's also something you need to think about it.
I suppose the flip side, though, of companies, as you said, being able to get lots of users very quickly, is that you can also lose them very quickly. So I guess my question is, going beyond the institutional companies like Microsoft, the ones that have accumulated now, decades worth of technological experience. Is it the case that maybe the time scale of the lifespan of a company is changing? Is there any reason to change the way we view time frames in investing because of this faster rise and maybe even fall of certain
But
companies?
definitely, I think we spoke about this in when we discussed about ChatGPT. You remember the problem of Google is facing. It doesn't have this level of diversifications compared to Microsoft, and it's very dependent on YouTube, on advertising, etc., etc. So again, Microsoft in this case, with his approach, which is I will call it like Berkshire Hathaway style, very diversified on different business. It's definitely a big advantage, I would say, because the minute, for example, your user, they are not anymore interested, etc., how you can capture your user to stay there, that's the questions. And this is like putting a massive pressure on this. So it's becoming like we are close, like you say, close to fashions. I mean, that's the say, 6 months, what's the fashion will be, that's the point.
But I guess on the other hand, then we live in a world where there's so much information and it's so difficult to get people's attention. I guess there is some value to users. Do you think it's the case that maybe we need to have a more effective way of quantifying the value of users, or is that too complicated a task, do you think?
No, it's not. I mean, Netflix, obviously, they are reporting the number of users, and anytime there is a number of users, there is a hype and the price is going up. But I think it's more, we need to go more into what kind of type of users are they stay, they don't stay. Because what I'm saying, if I'm taking up the business model of Netflix, I mean, you can cancel anytime.
Yeah.
So how is the level of retention here?
Yeah,
So
I suppose. Yeah. Sorry, I interrupted. I mean, I guess that's the biggest question for these companies, and in fact, it's not uncommon to hear about online platforms that they've been around for years, quite a high valuation, but still have not made a profit. And on the one hand, you might believe that they eventually will grow to become profitable, but on the other, you might be justified in questioning, how long is it going to take? You personally, do you feel comfortable investing in something which is not profitable by most accounts, but which has potential somewhere, or do you think it's it's a bit too risky in this day and age?
It's depending, like I say, your appetite, what's your time horizon. I mean, like I say, for how long it took for Amazon to generate cash. I mean, for me, I'm more in the school of I prefer like to see like real cash flow than like virtual one. Because like I say, company with, like I say, virtual cash flow are more difficult to catch because they are more on the hype. So it's difficult when to enter in from a timing perspective or when to exit, because the things are going so fast. The velocity is
Yeah.
very high. So that's the point. It's depending how you feel comfortable. And it's depending also, it's a generation questions, I would say. Which part of generation you are. Are you an old man or a young man? That's different. Your appetite, it's clearly different. So it will dictate if you like or not. I mean, NVIDIA definitely is the number one for the retail investors, and I presume they grew up with NVIDIA, putting the graphic card, have been like online gamers, etc., etc. I think the things, it's also there is a structural change of the audience. That's for sure.
NVIDIA is a very good example because, I mean, again, by most measures, the company is overpriced, but there seems to be so much hype surrounding AI at the moment. It seems every other day we hear about NVIDIA signing a partnership with someone or that I suppose. So would you say that at this point that most of the performance we're seeing with NVIDIA is driven by retail investors and people who are...
I presume, I mean, it seems the sky is the limit,
Yeah.
definitely. I mean, the valuation of a stretch, lot of, if you analyze the company from different perspective, everything is of a stretch. But the thing, it's like back at that time of GameStop, this is the things, the sky is the limit, and the retail investor, if they love the stocks and they are emotionally attached, you cannot go against this trend. That's what I feel.
And I guess this makes, I mean, definitely your job more difficult if because I suppose the rules of the market have changed somewhat, right? So
The emotional factors, yes. I
yeah.
mean, the emotional factor, it's different, and of course, it's very difficult to quantify the emotional factors. That's for sure. Especially the number of people who are intervening in the market. Post-pandemic world, we're in a completely different world. A lot of people are doing some like some videos talking about the stock market, talking about the general economy. So obviously, a lot of people are more interested, but also there is more actors. That's for sure.
It's an interesting way of putting it, the emotional market, because in a sense that's what it is. Kind of, it's shifting from one which was based on very hard numbers and facts to, I guess, one that is more emotional. To be honest, I don't. It's an interesting question about whether the rules of the market are changing or whether they fundamentally remain the same. And if I'm being honest, I'm not quite sure where I stand on it. I guess as a small recap, because I guess much of investing is based on trying to identify companies that are undervalued or which have good potential for growth, and especially to avoid overvalued companies. So on the one hand, the possibility that the stock market is becoming to some extent detached from reality, let's say, suggests that we at some point need to adapt to a new normal. On the other however, I guess markets are by their very nature quite adaptable. So I also find it a bit difficult to imagine them not being able to price in this new reality if we can assume that it is that.
I think, like I said, the capacity nowadays to adapt is crucial. Imagine, like I say, the pandemic took place in 2010 and not in 2020. Imagine, you remember back at that time, Windows 7, what's your ecosystem and what kind of applications you get. And the amount of data back at that time, the infrastructure was not ready for this quantity of data coming. So if pandemic, I mean, this is if, was in 2010, I'm not so sure we will be in the good conditions like where we are, because the technology was not ready, definitely.
So in a sense, we've just been lucky that it's
Yeah,
happened.
we have been lucky on this event, definitely. I mean, it's not a long time ago. We're talking about 10 years ago. I mean, definitely we have not been ready for that. And I mean, it's good, but also what in this new world, the competition is quite high, low barrier to entry, and you have a lot of options like Netflix. You have Paramount, you have Disney Plus, and Hulu, and HBO, etc., etc. So you have, as a consumer, you can move from one to one. So that's the things.
Well, I guess whatever the new reality is, what seems certain is that we're gonna have more volatility, and I guess with that more risks, but also opportunities. Which is, I guess, why it's always important to follow the advice of experts like yourself. So on that note, we've come to the end of today's episode. Thank you very much for following as always, and don't forget, if you liked what you saw, to hit the like and subscribe button.